All right, let's go ahead and get started with Chapter 1 of Managerial Finance in the MBA program. Really, we want to talk, before we get too much into detail, a little bit about what we're going to discuss over the next couple of weeks. Corporate finance itself really answers or addresses three questions. Number one is, what kinds of things should the company buy? We'll develop and ultimately utilize and test a model to establish the value of assets for a firm. The second thing that we'll then look at is, once we've decided what the things are that we want to buy, that is, once we do step one, we need to address the issue of where do we get the money to pay for things. So we're going to look at the variables that are utilized to determine whether or not companies should borrow money or whether they should use owner money. And finally, the third thing is we're going to address some short-term financial questions. How do we manage short-term assets and liabilities? What are the processes for that? So again, let's kind of move on a little bit and see if we can talk about these things and the key concepts or the constructs of finance. Financial decisions are based on what's referred to as a risk-return trade-off. There's a connection between the risk of assets and the returns that investors want. This ultimately impacts everything. It impacts the value of the assets. It impacts the costs of financing assets. Number two, the time value of money is the key construct. It's the mathematics of finance. It's how we analyze the data in our techniques to determine what the value of assets and projects are. Cash is not Cash is the king. Cash is ultimately the most important aspect of finance. Profit is not. And we'll talk about this in some detail, but profit, although it is very important, is not ultimately that thing that we want to utilize in our techniques, if you will. We're going to look at incremental cash flows, what happens once we make decisions. So not what the company is doing today, but the changes in cash that move forward. We're going to talk about competitive markets. Most finance theory is based on the construct that we have competitive marketplaces. However, in reality, markets are not perfectly competitive, and that creates, in some aspects, some good things for us, and some other things it is a detriment to making financial decisions. We're going to talk about the efficient market hypothesis. How do managers think? The efficient market hypothesis has to do with the mechanism that creates prices. It's a supply and demand mechanism, and the demand curve for stock prices in particular is driven by investors and their information that they gather. The agency problem. How do managers think? What is the process of the decision making at the manager level? We're obviously going to look at taxes, how they influence decision making. Ultimately, they could be a detriment to making decisions. We want to, again, spend a lot of time talking about risk. All risk is not the same. There is different kinds of risk, different aspects that we'll need to discuss. And then finally, number 10 here is that essentially ethics is the driving mechanism of everything that we do and talk about. All decisions should be made in the context of ethical decision making. So let's kind of move on. We have there's essentially four kinds of companies, or four types of firms, if you will. I'm sure you recognize all of them. As we work our way through, though, we want to discuss the techniques of capital of corporate finance. Obviously, that's the context of the course. However, all the techniques that we talk about can be incorporated or adjusted to fit any type of business. So sole proprietorships, there's one owner. Partnerships, obviously there's two owners or more. Corporation, we offer stocks, bonds, etc. to investors. And a limited liability company is a mutation or a hybrid, if you will, between a partnership and a corporation. So if you kind of look at the first little picture here, it shows how businesses can be characterized, if you will. See that about 71% of the companies are sole proprietorships, or actually a little bit better way to look at this is only 19% of all corporations, of all businesses are corporations. So they're a very small segment of our economy, if you will. And of those corporations, only a small segment of those corporations are publicly traded. On the other hand, if you look at the amount of revenue, 84% of all the revenue comes from corporations. So it's the corporation that ultimately provides revenue, obviously to its owners, investors, but also this has some obvious implications for taxation, right? If we increase the taxation or increase taxes on corporations, certainly they are going to react to that. But ultimately, you want to place the tax burden where the greatest amount of taxes for the least percentage can ultimately be gained. So what about a sole proprietorship? Obviously, there's one person. They typically have very few, if any, employees. It's very easy to create. The challenge, though, is really twofold. Number one, is it has an infinite life. Excuse me. It has an infinite life. If the owner decides to do anything, if they decide to quit someday, the sole proprietorship's over. If they pass away, the sole proprietorship is over. So it has a limited lifespan. The additional part here talks about liability. Unlimited personal liability essentially means that the owner's assets, both his personal assets and business assets, are viewed as being one pile. So should anything bad happen to the company, the creditors or the people who are entitled to assets from the company can take whatever they want. And of course, if the owner's rather successful, probably has lots of nice personal assets, but maybe the business doesn't have many assets. So this is actually one of the critical challenges to a sole proprietorship. It's the riskiness of being sued and what that ultimately could do to the wealth of the owner. Partnerships, very similar to sole proprietorships, except there's more than one owner. Essentially, all partners are now personally liable. So that unlimited liability of the sole proprietorship falls through to what are referred to as our general partners. And again, when a partnership ends, it could end with the death of a partner or a withdrawal of a partner. So partnerships, general partners, are very similar to sole proprietorships. A limited partnership has a little bit of a hitch to it. There's actually two kinds of partners, a general partner and a limited partner. And the idea here is that the general partners have this unlimited liability. They run the company on a day-to-day business. The limited partners, however, are essentially what we used to refer to these as silent partners. All they do is contribute investment money, but they're not allowed to take any management authority inside the company. having said this, since they don't participate in the business and they only have the investment to show for their ownership in the company, they also have what's referred to as limited liability. They can only lose that investment. They cannot lose anything in addition to that. A limited liability company is a relatively new kind of business, but in this case, instead of there being general partners and limited partners, all of the owners have limited liability, and they also can all participate in the business. So there are a lot of different kinds of or types of businesses beyond these four that we're going to talk about. We have subchapter S businesses. There are master partnership businesses. There are limited liability partnerships. There's a variety of different types of businesses that are hybrids of the three primary businesses, which is sole proprietorships, partnerships, and corporations. A corporation is a legal entity. It has all the legal powers of a person with the exception of being able to vote. It's responsible for its own obligations. Its owners are not responsible for its obligations. So let's kind of look at a corporation, right? You're a shareholder. The corporation owns $5 per share before taxes. After it's paid taxes, it's going to distribute the earnings to you as a dividend. The dividend income to you is income to you, so you're going to have to pay taxes on it. The corporate tax rate's 40%, and the dividend income is 15%. So the question is, how much money do you ultimately get in the end? So first of all, the government the corporation pays taxes. It earned $5. It's going to have to pay 40% tax. 40% of 5 is $2. So that leaves $3 to distribute. So it's going to distribute this $3 to you. However, you have to pay a 15% tax on the $3. That's 45 cents. So in the end, you receive $2.55 is the amount of all the taxes are paid after taxes. So ultimately, you pay $2.45 in tax, you get $2.45, and essentially what that tells us is that there is an effective tax that owners pay. It is the accumulate. It's an accumulation of all taxes, both at the business and at the personal level. So in this case, owners effectively pay around a 49% tax bracket. I guess the question is, what would happen if this is a subchapter S business, and then the tax on non-dividend income essentially is 30%? So what tax would you pay? Well, again, 30% of the $5 is $1.50. So in the end, that's a lot less than have to pay the $2.45 in the previous chapter. Now, obviously, this subchapter S is a different type of business entity, but it's a business entity that essentially you pay taxes as an individual, and you don't have to worry about double taxation, which is double taxation at the government level or at the corporate level, excuse me. So essentially, instead of paying about 49% taxes, again, you're only paying 30% in taxes. The corporate management team, obviously, you know, there's a corporation, is in direct control by shareholders. However, the shareholders don't deal with day-to-day business and the ongoing strategies, etc. of the business. The board of directors are elected by shareholders, and essentially they have the strategic planning of the company. They hire the executives of the corporation, and they essentially oversee this broader range of strategies, paying of dividends, etc. It's the CEO that delegates the day-to-day decision-making of the corporation. So they're ultimately in charge with the production, the providing of services, etc., the production of revenue. That is the job of the CEO.